Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for October 4th, 2014. We have a market that is in bullish volatile conditions. On an annual basis, using weekly RSI 14, we're at the high end of neutral at 57 out of 100. On a 10-day basis, using the 10-day NDX, we are right in the middle of neutral at 52 out of 100. Looking at the market mosaic, long-term trend, price relative to the 200-day moving average, we are in red bullish conditions with about a 2% cushion between bull and sideways markets at 4.13%. The slope of the 50 turned negative and is red bearish at 0.07%, minus 0.07. ADX is at a untrending or neutral 16.8 with bears in charge. Volatility, the ATR percentage, moved up over 1.0 to 1.08, which makes it volatile. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold is 1.0 for the difference between risk off and risk on. Current reading is at 0.88, which puts us into risk off conditions. Take that reading of 0.88, look back 5,000 trading days, and find the average and standard deviation. That gives us a risk z-score of minus 1.55. You can see the last 90 days of that indicator on this histogram, and you can see that we're now at 1.55. When you get turning points at extreme moves, you get excellent swing trades, and so we'll be stalking for a return to quiet volatility, looking for swing trades in XIV, but we'll be prepared for intraday, one-day trades using VXX or UVXY at this extreme condition. From extreme conditions come extreme results. You can see the current holdings of the blended monthly rebalancing for 3 different portfolios, and then the current leaders of those portfolios based on Friday's prices, and then with the leading candidates for relative strength from the Dow 30, ETF 200, and the ETF Max. In ETF 2, the theoretical exposure of the model is at 20%. The actual model portfolio will be at 60% exposed. Just a quick look at the 13 and the 32 ETF portfolios. You can see the predominance of cash and the strength that's still in the U.S. large caps and tech. Treasuries becoming more attractive. This looks at ETF Max. This is the top 50 or so in the ETF database. China, coffee, Middle East, India, Thailand, more India. Again, I like the ones that are green and then white, so the dollar bullish index is of interest because it's green on 3 months and white on 6 months. It may be early in the life cycle. That should be of interest to the currency traders. Egypt is green and white. Market vectors, high yield munis, green and white. The ones that are white and green are ones that are suffering. So you have like global carbon is negative on the last 3 months, but still up 35% 6 months. So you can see how the life cycle of that may be over already. Excuse me. This is the S&P 500 through the same lens. U.S. Steel has moved into the second position, taken over now by Sigma Aldrich, and now you can see the sector that each of these symbols is a member of. XLV and XLB tending to dominate right now. Amgen, Kohl's, and Intuitive Surgical of interest as green and white, as is Yahoo, green and white, and Goldman Sachs, green and white. This is the market health check. Vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that were once resistance levels, which have held in the past. Purple lines are price targets to the upside. We need to see closes above those purple lines to feel confident about the continuation of the bull after this little sell-off here. The blue lines here are the 10-period RAF regression channel formed by a 10-period regression line, and then the channel is formed by the maximum excursion during the look-back period. The blue is sloping sharply down. The black channel is the 30-period, lagged by a day, and you can see that it's also rolled over and pointing down. The river has gone flat, and then, as you can tell by the Bollinger Band mean, is starting to shape negative as well. So the dark blue shaded area is the river. That's the 30-period Bollinger Band plus or minus 1. The lighter blue shaded area is the river floodplain. Excuse me. That's the Bollinger Band 30 plus or minus 2. The pink ribbon is the 10-period Bollinger Band plus or minus a half. That gives us a much more adaptive undercurrent we call the dragon. That often turns well before the river does, and then acts as a noise buffer on either end when we're in extreme. So you can see in this case where the dragon came completely out of the river after an extreme move down. When that was breached, that sets up a nice swing trade. And now this weakness here is troublesome. The second weakness on the breakthrough there actually becomes a signal for us on the downside. We now have price had fallen out of the river and right to the edge of the third Bollinger Band, and so this is setting up a Z pattern for a recovery. This is actually a market at a critical state here, trying to find support with two higher lows after a move outside of the floodplain, and now getting ready to re-enter. So we'll be prepared to play for a return to the far side of the floodplain and the river, and at a minimum targeting the Bollinger Band mean on the upside. Failure here goes back to retest 194, and if that fails, down to 191.5 at the last support level that we've noted. This sine wave looking black indicator here is the slope value of that 30-period regression line that you see reflected in the RAF regression channel. And this dotted line in the middle is the zero line. So whenever that black line is above the dotted line, then the 30-period slope is up, and that's healthy. We get extreme turning points noted here in the blue circles, and when it crosses that zero line. So we're below the zero line, so the slope is negative. When we read back across, we're at minus 0.10 on the slope. It has to get down to minus 0.22 to really be extremely steep down. But the last time that it got down here and turned, it takes about 3 or 4 days for that to reverse and get well, and then that becomes an interesting turning point. So we'll be stalking potential turning points if in fact this 194 is going to hold. We've been oversold a couple times, and one-day recovery in here. The jaws of percent price oscillator, however, are still open to the downside, promising more weakness. So this is certainly a market that's in a critical state. It should hold here if you're a believer in buy on dips, and if it does, that will still be favorable because we will have had intermediate term swings with higher lows. Moving on. 8 of the 10 symbols in the ETF2 index model are on buy signals. Their prices are better than their 4-month moving average. The other ones are on cash. That puts us at a 2080 model allocation, down from a 3070 last week. We're still bull volatile. The S&P is better than the globals, with 80 being better than 68 on the strength. Inside the U.S., it's tech at 85, large caps at 80, mid caps 74, and small caps at 69. The two strongest sectors are U.S. tech and U.S. large caps. Two weakest sectors, European 350 IEV at 66, and then EFA at 68. Inside the U.S., strength in the financials, technology, staples, and healthcare. That might be an interesting look then at Goldman Sachs in the financials. We saw that in an earlier slide. World market model shown graphically using the strength reading. You can see that all the U.S. large caps are above average, tech especially so. Now weakness has crept from the small caps and expanded to the mid caps, except for mid cap growth. Latin American emerging markets now back underneath the average. Japan and Asia, less Japan below average. A few leaders in Asia, India, Thailand, Philippines, Vietnam, everything suffering in Europe and all the countries of Europe. and you can see that the strength in the U.S. business sectors, finance, tech, staples, and healthcare, are mirrored by strength in the global sectors, but the U.S. has the hat tip as being the preferred location. You can see the strength of the dollar up in the currencies. ETF top 30 tells us the same kind of story using that lens. And the Dow 30 led by Nike, Intel, Home Depot. The new leaders, green on strength and white on consistency, meaning money's flowing into them. DuPont, Coke, Procter & Gamble, JP Morgan, as well as Merck, Travelers, Johnson & Johnson. Only United Tech and Caterpillar suffering right now in the red on strength. We'll shift now to the daily report. We've got a couple good signals in here. We've got an overreaction in XLB, a 5DD in Europe, Energy, and Chevron, triple screen in Procter & Gamble, 551Ws in financials, and a set of large caps, and then plenty of symbols that test out well on the auto framer. Just notice the change in volatility that is now at a 100-day high. It's moved out well into volatile, and that on the ADX that the bears definitely have the strength of trend, and the trendiness is starting to increase. With bears in charge, that's a bad sign. The tactical summary, lots of good frog quality candidates here among the Dow 30, plenty of good auto framer candidates as well. In the red, you can see the symbols that were percent losers on Friday. In the green, these were the exceptional winners on Friday. Nike and Coca-Cola and Cisco should all be of interest since they all closed above their previous trading ranges of 10 days, 1 month, and 3 months. So that's long-term relative strength breakouts from trading ranges, and those ought to be investigated. Same lens for the ETF 30. A number here firing on the RSI 2. When that number is below 10, that highlights as a short-term washout potential. Lots to choose from on the auto framer. XIV and Brazil both had strong days on Friday, suffering in silver, gold, oil, and the VIX. The auto framer stats and the regression line fractal framework for relative strength leaders and laggards, and then the ones that auto frame out well better than 2.5 to 1 on the reward to risk ratio for swing trading 1 day at a time. Just some reference charts for you. Here's one I want to look at. The z-scores of the regression line slopes of the last 180 days, 3 of them, the 10 has bottomed out and started to peak up a little bit when price dropped out of the river and is now back at the edge of the river. The 30, the last time that we saw this little intersection right here, there was a nice little price bump. So that would take us back to the top of the river, about 198 in the S&P. And the 90 has cooled from its z-score +1 and has now come back to the longer-term bull market average. So this would be seen really as a potential. The nearest neighbors are here, nice move. Here, nice move. Here, nice move. Here, potentially nice move. The only thing to be concerned about is this pullback was a little bit weaker than the previous legs up. Even the strength of this gain was really after the extreme move off the bottom and then kind of flatlined for about 30 days before failing. So there was not a persistent gain riding the north edge of that shore. So that's why, to me, the upside target is the top of the river at around 198-ish. And so failure below this swing low and then that swing low puts all of this move at risk. So this is clearly a market that's in a critical state. So keep your risk measured and your powder dry, and we'll see you in the chat room. Take good care.